Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap trading alert that we do here each and every night. Today was a really crazy day with a lot of contracts expiring for March, and then we had a lot of closing orders and 2 opening orders. So there's a lot to get through tonight, so we don't want to waste any time. But before we go over anything else, I want to get to part 2 of this Nike strangle that we made yesterday in Nike before the earnings that happened overnight. So yesterday, for those of you who haven't watched part 1 of this just 2-part quick series on Nike, yesterday we traded a strangle right before the close of the day in Nike before it announced earnings. And implied volatility was really high, up in the 70th percentile. And so this was really good time where premium was very rich, and we traded a very even, very nice wide strangle in Nike. Well, today Nike had earnings and jumped down lower. Earnings were okay, but not as good on the guidance side or the outlook. And so Nike was down considerably during the day. So what we did is we actually hedged this trade and kind of recentered our trade by adjusting one of the legs on the strangle. So if for those of you who don't remember or want to go back to that other video before you do this, you can obviously pause this one, go watch this one, and come back. But we're going to get right into it here with Nike with the first opening trade. So this opening trade was a hedge, and basically what we did is we took the call side trade because Nike had moved lower. And let me go to the chart of Nike first before we take a look at this on the top side. So you'll notice here that today we had a huge move in Nike after earnings, right? It closed up here around 79 and some change yesterday. And then today it opened up right around 77, which is about where it was trading at after hours last night. Now today it opened up there and it was all over the map, and then closed at the low end of the day, mainly because the rest of the market kind of continued to sell off as well. But because it did this, what we did is we adjusted the top side of the market. So we went back and we closed out our 82.5 calls, which are the ones here, and we sold a call that made our position now inverted. So we have a 77.5 put and a 75 call. Now this is a little bit different, and most people don't know how to use this strategy, and they think when they go inverted on these strangles that it actually makes this divot in the profit loss diagram where they actually have this kind of area between 75 and 77.5 where they can lose money. And that's not the case all the time, and although it does sometimes happen, especially on some butterflies and iron condors, etc., with a strangle, that doesn't always happen. Your just overall profit goes down because you reduced it and kind of recentered the position. So by doing this, we took in an extra credit of $2.10. So we closed out the call side trade by buying the 82.5 call and resold and moved that leg in closer to the market at 75. So again, recentering our strategy. Now, what does this look like on the profit loss diagram, right? That's what everyone always wants to see. Well, here's the profit loss diagram for Nike. Now remember, yesterday Nike was trading around 79 and change, so right about here on the graph. Now today Nike closed just about 75 and a quarter, so 75.22, which is right about here. So what we did is we kept our same 77.5 short put, and you'll notice down in the bottom here that we're still short that 77.5 put. And what we did is we moved that 82.5 call leg down to 75. So that 82.5 call leg now has no contracts, and the 75 call has 1 contract. So you'll see that we took off the 82.5 call and replaced it with the 75 call. And what that's done now is that's created 2 new areas where the profit loss diagram turns or pivots. And it kind of recenters the strategy. So now we have a nice bigger window centered more evenly around where Nike moved after earnings. So now our break-even points are up at 79 because of the credit that we took in. We add the total credit, and that moves our break-even point up to 79 on the top side and down to about 73.5 on the bottom side. Now look, the reality is at this point, all of the earnings news has come out of Nike. So there's probably going to be a little bit more volatility in the stock as people start to hear the news and trade the security. But generally speaking, we're going to get a continued crush in volatility that we've already seen, which will only help our position. And by recentering our position around where Nike's trading now, we still leave ourselves a nice window of opportunity to make a profit, even though Nike had a huge move, right? Most people will get scared away from this and just kind of close out the whole position altogether. But you got to be nimble in this market and with all of your options trades. And so by adjusting just the top side down, by adjusting the 82.5 down to the 75 and moving these strikes down, that allow us to then recenter the position around where Nike's trading right now and give us an opportunity to make some money on it. Now look, I told you guys the other night that if there was one thing I was certain of, regardless of the direction of Nike going, the one thing I was certain of is that implied volatility is going to drop like a rock. And that's exactly what it did. So yesterday, implied volatility was in the 70th percentile. Just one day later, we're now at the 42nd percentile. And I do expect that this will continue to drop, which will only help our two short options because they all are built with premium and with time decay. And so the closer we get to expiration and the lower that volatility drops, the quicker these things are going to start to make money for us. So I hope you guys really enjoyed this. This was a very good two-part series, and while I don't like adjusting trades, I always like if Nike just traded right in the middle here and implied volatility dropped, we would have made a nice big fat check. But at the end of the day, this is trading, right? And nothing works exactly like we want it to, and this is exactly how you adjust these types of trades even after earnings. So you still don't get burned on this, still don't have a loss on this, have a nice big window of opportunity, and are still positioned very, very well for a drop in implied volatility to continue. All right, let's move on to the other trade that we made today. I'll just quickly note that this trade in C, which is Citi, actually happened after we had closed out our current position in April. So we had an April put spread that we had on in Citi. We closed that out for a profit, which we'll go over here later on in the video. And then we went ahead and reopened a new position for May on the top side of Citi. So we went ahead and sold the 52.5, 55 call spread. We took in a nice credit of 65 cents. And really the only reason that we did this is twofold because, or not the only reason, but there's twofold. One, Citi has continued to move up, right? So we got rid of our Citi position on the bottom side for April because Citi moved up, and that's really what we wanted. We wanted the stock to move higher. That helps our put spread position. It was just a no-brainer. But here's the thing. Implied volatility has stayed really, really high for Citigroup. It's up in the 60th percentile. So that gives us an opportunity to then make a trade on this thing and give ourselves room with our first strike at 52.5 here. It gives ourselves room to be wrong even if Citi continues higher and still be right in making some money. So this is a good trade-off. We kind of traded the front month options, which are now the April options, for the back month or the May options, and increased our premium. We took profits on one side, and now we're trading the other side of the market. All right, let's go down to some of the closing trades that we had here today. I'll go over some of these ones that expired fairly quickly because these ones, while some people in other newsletters out there and other services don't go over all the expireds, I always like to throw these up because now, while these aren't necessarily closing trades that we made, they are trades that expired worthless. Whether that's good or bad, you can see we had some losses, some profits, etc. But the first one is the vertical in DIA. So we had originally traded an iron condor in DIA. We had closed out the call side trade originally at a profit. So we had closed out that leg of the trade originally at a profit a couple weeks ago. And then today we still had the put side trade that has been working the whole time. And obviously the market continues to run higher. So this thing expired completely worthless, not even close to our strikes at all. We took in the full $22 profit on this leg. So overall, it was a great trade in DIA. The original iron condor that we put on, we legged out of the call side, which ended up being really good. And we kept the put side in, which ended up, again, giving us a full profit. So a great iron condor trade and a great testament to legging in and out of trades. EWZ is another one that we let go all the way to expiration. EWZ has just recently popped in the last couple of days. And because of that, we let this thing go all the way to expiration. We had the 40-39 put spread. So we wanted EWZ above 40, and it did close above 40. That means that we kept the entire profit of $28 per spread. So again, with 6 contracts, that was a very nice winner for us. FCX is one that was a loser for us, and really was a loser because it just moved so far so fast from where we wanted it to be. So we originally had bought the 33-34 call spread, and FCX just continued to move lower than that. So it really just kind of hurt our position going forward and really gave us no chance to adjust it along the way. You can see that it just quickly dropped like a rock a couple weeks ago. We thought at some point we get an opportunity to make some money, and we got a nice little rally here before expiration date, but it just wasn't high enough to get us back to where we needed to be. So after that, it just made such a quick move. You can't really account for those. Again, that's just why you keep your trade size very, very small. But in this one, we took a $53 loss per contract that we sold or let expire. So it was a little bit more of a loss than we wanted to take. Obviously, we would have loved to get out of it at some premium, but premium just dried up really too quickly. The next one that we got rid of or let expire today was XRT. Now, if you go back to some of the video trading alerts, and again, as a member to optionalpha.com, you can see every single one of these videos. It's right here in the video that you're actually watching. If you're watching it on our website, you just click the playlist button in the top left-hand corner of your screen. You can go back and sift through all of these trades. But this was a trade that was originally a broken wing butterfly, and we had adjusted because XRT had moved higher and then made it a free, even, or balanced butterfly. So we had adjusted the trade and bought back the embedded put spread in this trade and made it an even butterfly of 80, 79, and 78. Basically a lottery ticket centered around 79. Well, XRT didn't get anywhere near that, but that doesn't mean that we didn't keep all the money that we had originally took in as a credit. So we took in a nice $50 profit on this trade. It was a really good trade, a great testament again to adjusting broken wing butterflies as the market moves away. The last one that we let expire today was Apple. Apple was more of a hedge this whole time for us towards the bottom side, so we actually wanted Apple to continue lower from where it was at. It was actually one of our negative delta trades that we've had on for quite a long time now. I believe we entered this trade back in January, and just continue to be a really good hedge against the market. We had originally bought the 505-500 put spread, and we bought it for 270, so we took that full loss today, but that's okay. Again, it just moved away from us way too quickly. Apple just continued to move higher with the broad markets, but it always stayed as a hedge, and that's exactly what we needed in the meantime. Some of the other trades that we manually exited today are JP Morgan, Citi, and COF. All of these ones, including IBM, we took for profits, so let's go through them individually. JP Morgan, what we did is we bought back the 55, 52.5 put spread, and we bought that back today for a 12-cent debit. So that means we took in a $39 profit per spread that we bought back today. Really the story here with JP Morgan is that the stock continued to move higher, which obviously helped our credit spread position below the market. So we had the 55s down here, and you can see the stock continues to move higher. And on top of that, we also saw a drop in implied volatility. So that really helped our position as well. And for only 12 cents, there's no use in risking all this time between now and April expiration for another 12 cents. We've made $39 on the position right now, so why wait and risk another $12 all that time? It's just not worth it. The stock could easily turn back around and turn into a full loser. Citigroup was about the same thing, and again, remember that we had entered the new position up above, but today we bought back 8 of the 48, 47 put spreads that we had originally sold. It was a small profit of $11, so a small profit per spread. But when you times that by 8, it actually ended up being a fairly decent sized trade. So we made about 88 bucks on this thing. A very nice trade. Would have been an even bigger trade, and we only bought it back for a debit of $20. But you'll notice that even though the stock went exactly where we thought it was going to go, the one thing that we didn't have work in our favor in this particular instance was that implied volatility usually drops, right? So this is a great example of showing that we sold this thing back down here near the lows when implied volatility was high. The stock rallied, and most people would think, okay, you know what? The stock's going to rally. Implied volatility usually always drops. Well, that's not the case right now. So Citigroup, as the stock rallied, implied volatility actually stayed fairly stable the whole time. So while we did see a drop in premium just because of the price movement in Citi, we didn't see that extra drop in premium because of the drop in volatility. So what usually would end up being a 10 cent or 12 cent debit, kind of like JP Morgan, actually ended up being just a 20 cent debit, but we're still going to take the profit on this one. It's still a very close trade. Our strikes were at 48 and 47. So you can see that we're still within a stone's throw distance at this point with 8 contracts. It's great just to take the money off the table and bank a profit heading into April. COF is another case. These are all these financials that are just moving higher. COF was one that we bought back today. It was the 70, 67.5 credit put spread that we had originally sold. Same thing with this one. For $20, it's just not worth waiting all the way until April expiration. So we banked a nice $33 profit per spread that we bought back today. I'll go to the chart of COF, and you guys can take a look at this one as well. You'll see that it jumped up early in the day, and that's when we sold it. And really, this is the name of the game, right? The market gives you exactly what you're looking for. Implied volatility now right at the 50th percentile, so it's continuing to drop, and that helps our position. Now, we could have easily hold this thing for another couple days, but really at this point, we've made over 50% of the potential that we could make in this trade. There's only $20 left. There's no point letting this thing go all the way to expiration, letting it ride out another 30 days or so, just to potentially see Capital One reverse course and head down and turn this thing into a full loser. So at this point, it's prudent, as I always preach on this blog and with these videos, to get rid of some of these positions and bank the profits. It consistently works for us. And while it doesn't seem like that's what you should do, most people are very greedy and try to go back after these $20, 20 cent, 10 cent, 12 cent profits. It's really not what you should be doing. And eventually the probabilities on that end are going to catch up with you. Now, the last trade that we made here today to close out is IBM. So this is one that we have been trading really, really well. And I wish I could trade IBM this well all year long. We had a trade for February that worked out. We entered this trade for April just a couple days ago. I believe it was last week. We actually sold the 175, 170 put spread. And today we made over 50% of the potential profit we can make in this and bought it back for a 40-cent debit. And again, I just wish that we could trade all of our securities this well. And whether it's just good timing on IBM or implied volatility movements, whatever the case is, it's just been a really, really easy stock to trade. So if you remember, we made a trade in IBM and took a profit as IBM moved down back here in the latter part of March, heading towards expiration, and then came back in here and sold the 175, which is really, really, really well below the market. But as IBM continues higher, then this security down here that we sold, this 175, 170 put spread, dropped in value. So we could have definitely held this one for a little bit longer. It was only, I believe, one contract that we sold, so it wasn't a big position for us. A $50 profit more than covers everything that we had in this trade. If you have multiple contracts, you can start to leg out of these things, but there's nothing we can leg out of because we only have one contract or one spread in. So if we had 3 or 4 or whatever the case is, just given the fact that we're so far away from where the market price is in IBM, this might have been one that you could hold on to a little bit longer, kind of slowly close out the position and slowly roll the position off. But again, for us, it really just didn't make sense because we only had one contract for IWM or one spread. So it was great just to, again, bank the profit and move on to next month. So, as always, I hope you guys enjoyed these videos. I know this one was a little bit more long-winded, but it was a great example of a couple things, of closing out trades early in the expiration cycle, talking about things that expired, why we let them go to all the way to expiration, whether they were winners or losers, talking about butterflies that we had adjusted originally in the cycle, iron condors that we had adjusted and legged out of that ended up being really good winners like DIA, and then also talking about Nike and that strangle around earnings. I think a lot of people in this business, when you get started in options trading, you get very scared about trading strangles around earnings, the quote-unquote undefined risk feature, the feature of what's going to happen if the stock makes a huge move after earnings. And I'd have to say that Nike made a pretty significant move after earnings, probably not the biggest move I've ever seen, but it made a pretty significant move, and we're still in a great position with Nike because we were just very, very prudent in adjusting our position, recentering the strategy right around the stock, and that's obviously going to set us up for the best potential to make money going forward. So again, hopefully you guys enjoy these videos. Have a great weekend. I'll answer all the questions either tonight or over the weekend before Monday's open.